Hello, my name's David Miller. I'm the manager of Nexus Global Solutions Portfolio and the co-manager of Dynamic. It's early April in London and it's a beautiful day. So, another good month for investors. Dynamic now is up nearly 10% year to date, Solutions about 6.5%. So the uncertainties at the end of last year have been washed out pretty quickly and we're making good progress now. What's behind this? Well, I think we're getting it right at the moment, both in terms of asset allocation and stock selection. The concerns that were bothering investors in the last part of last year just haven't become reality. Our view, which has proved to be the case, is that economic growth would continue, it is, and that good companies would make profits and that investors would benefit from that. So that's where we are at the moment, and that really is enough of the past. The key thing is where next. Well, we're building for the rest of the year off a very firm foundation, both in terms of diversification of assets and the securities we've selected. Solutions is around 87% invested in fixed interest and equities, 13% in alternatives. Dynamic, the equity portfolio, is 96% in equities, just 4% in cash at the moment. Both of them are pretty fully invested within the mandates for these portfolios, and that's a reflection of our views. What it isn't at the moment is simple. There are a lot of moving parts. As I said, growth looks okay, and that was the concern earlier in the year. But the numbers are coming through now, which is great. So that should be good for equities, and it is. But usually when it's good for equities, it's bad for bonds. And as I said, we've got a substantial position in fixed interest within Solutions. But the bond markets are also doing well. And the reason for that is that the growth isn't too much. Interest rates are unlikely to go up, and inflation steadfastly refuses to re-emerge. And that's a good environment for bonds, which is why the core of Solutions, bonds and equities and bonds, 58% equities, 29% in fixed interest and cash. That core is performing well, and that's why the numbers have been so good this year. Then, on the periphery of that at the moment, we have the alternatives, hedge funds, private equity, infrastructure, and also gold. And normally gold does badly when equities and bonds are doing as well as they are, and the dollar is also strong, but not this year. And the reason for that is that it's possible that the world won't be quite as I've described it, in which case there is a benefit to having that diversification into something which moves in a different direction. And that's bringing investors in, keeping the price up. So as you can see, it's a well-diversified portfolio where we've got the portfolio positioned for a view of the world, and we're testing that reality, that view, as the numbers come in. So far, so good. At a security selection level, and I always like to talk about that because that is actually what makes the return, not the theory, not the asset allocation by country, but the investments we actually make. Well, a broad range of companies we hold are doing well at the moment. Just a few examples, just to give you an idea. Prudential, UK insurance company, which we all know and love, been around for years. It's the business that they do in Asia which is driving returns. And that is attracting investors with capital and pushing the price higher. Then we've heard a bit about 5G, it's on its way to us. Cisco, Cellnex, a European and a US company, both heavily involved in that area of development, that sector, and we want to have a part of that within the portfolios. So those are the building blocks, those make the return that I've been reporting on. There remain uncertainties, of course there are. The US-China trade deal does matter. Evidence from China is looking a bit better, but it would be nice to get this particular uncertainty out of the way. And then those more interested in the UK will be thinking, why hasn't he said anything about Brexit so far? And the reason for that is that in market terms, the assumption is that the exit will be delayed and that when the exit happens, there'll be a deal. No deal isn't in the price. Many things might have to change if there was a crash out at some stage. It looks less and less likely, and I'm not making that as a prediction, but I'm saying that's what the market is telling us. So uncertainties as ever, but the foundation is economic growth on a global basis, and good companies are making profits, paying dividends, and investors in these two portfolios are benefiting from that. So that's where we are at the moment. Very much a matter of paying attention to the detail, but against that background, which I think broadly speaking is encouraging. Thank you for your attention.